Perfect. Yeah. Well, thanks everyone who has joined for joining. Yeah, we're really excited to have not just Paul joining us today, but actually the whole investment team. So yeah, we're very keen to hear what interesting insights they have to share with us. And thank you all for making the time to be here and attend. So Paul and the team are going to run through their presentation, and then at the end, we're going to have a time for questions and answers. So please, if you have any questions throughout the presentation, put them in the chat and then we'll get to them at the end. And then we'll also open up the floor at the end for any additional questions as well. So yeah, over to Paul and the team.
Great. Thank you so much, Sarah. Yeah, thanks guys for your time. Obviously, I know you all get to go to get invited to a lot of these, so it's always nice to have you on our update and hear what we have to say about the economy and what we're thinking. Obviously, a lot's happened since we last met. My last presentation in August, uh, we hadn't started dropping rates yet, so we've had some exciting developments around, rates starting to drop in the US and South Africa. And then also, obviously, the massive, the election outcome that happened yesterday, that got finalized yesterday. So, I think it's important that we're definitely going to spend some time on that because there definitely are some economic and market ramifications from what happened, and we'll go through that as well. But yeah, just before we get into that, let's just look at fund performance. So if we just do a quick analysis of our fund performance over the last year, all six funds that we manage comfortably within their first quartiles. So we're very happy with that. Performance continues to be very good. Our exposures are working out for us. Our thematic equity investments that we've invested in are doing very well, and we still see that holding. We'll talk a little bit about that later. If we look at the last 3-year returns as well, so out of the six funds we manage, essentially, okay, look, Enhanced Opportunities is not 3 years old yet, but essentially kind of first quartile or well within the second quartile. So quite happy overall with our overall offering. Yeah, things are looking positive for us, and as I say, sort of market expectations and what's happening in the market fitting in well with our portfolio construction. Obviously, us being more focused on portfolio construction and asset allocation, it's important to get those asset allocation calls right, which is what we're doing. So if we get into it, obviously massive news yesterday. Everyone's kind of talking about the elections. So when we put the presentation together, we still weren't sure who was going to win. Obviously, we had done some homework on what we thought would happen post-elections. And obviously, you get with these things, you get first round effects. So you get initial market reactions, but then you also get like second and third round economic effects further down the line. So we've kind of tried to kind of distill it, not just to look at the first round initial reactions and the initial effects, but also looking through that and how does the economy unfold in the second, third round effects down the line. What's the impact 3-4 years down the line, not just over the next 2-3 months. But if you look at it, obviously Trump coming out with, pretty convincing victory. He's got a very strong mandate, a much stronger mandate than he had when he won in 2016. He's won the Electoral College. He's also won the popular vote, which is the first time a Republican's won the popular vote since the 80s. Ronald Reagan was the last Republican to actually win the popular vote. So he's won the popular vote by roughly, it looks like 5 million votes, quite a significant margin. And then obviously the Electoral College was, for all intents and purposes, a landslide victory. He'll sit with over around about 312 Electoral College seats, and you need 270 to win. So a very big win. If you look at the Senate, or actually both houses of Congress, if you look at the Senate and the House of Representatives, the Republicans take back the Senate. So the Senate they were sitting at 100 seats in the Senate. They were sitting at 49 seats pre this election, and they've won 3 seats. So they're sitting up at 52 seats now. And then also the House of Representatives, it looks like they will continue to have the majority in the House as well. So what it boils down to essentially is that the American public has given Donald Trump a very strong mandate. So he's going to be able to push through a lot more of the policies that he wants to push through because he's going to have the support of both houses of Parliament or both houses of Congress. And he's got a really quite a large majority in terms of the vote as well. So feeling like, from the confidence that the public or the voting public has given into him, it's quite massive. It's not, the previous 2 elections before this one were very close, very tightly contested, but this one was really a walkover. It looked to be quite close based on the polls, but generally what happens in the polls is they underrepresent Trump a lot. I think a lot of people don't like to say publicly that they're going to vote for him in a poll, but privately will vote for him. And you saw that clearly playing out in the election results. Something that we kind of expected. So we were kind of expecting, or it was always going to be, it's designed to be a tight race, relatively speaking, but we were kind of expecting more of a Trump, leaning towards Trump. So if you look at kind of some of the policies that come up, look, he proposes to decrease tax. So there's a lot of, from both candidates, actually a lot around tax, a lot around what they're going to do with tax, both proposing tax reductions. But where Trump's proposing a much larger total tax reduction. So a decrease in tax to all households on a personal income level, but also decrease in corporate tax. So he's proposing a 15% from a 21. So that's going to be quite bullish for equities, we think, and could be quite a big tailwind for equities, and you actually saw US markets bouncing quite heavily yesterday. From a trade point of view, he does want to impose trade, so he's specifically wanting to sort of regulate what's happening in China and all the outsourcing that American businesses are doing to China. So he's imposing quite heavy tariffs across the board to China, but he actually wants to propose a 10% universal tariff across the board to any imports to try and protect American interests in American labor as well. So it'll be interesting to see what happens here. But as I say, it's got quite a strong mandate, so it's likely that a lot of these things will go through as they've sort of been booked to go through that. Higher fiscal spending. So it's interesting. So both candidates will propose higher fiscal spending. Gone are the days of kind of fiscal consolidation. Conservative parties these days are still economically fairly liberal in many ways. You're not seeing much austerity in any government around the world these days. The kind of general move is still more debt. But if we break this down, where he wants to kind of invest, there's a lot more subsidies in terms of the private sector. As I say, this theme of protecting American business interests, protecting the American economy, a lot more protectionist than Kamala would have been. Security spending. So we obviously know what's one of the big differences between the two candidates is on the border, controlling the border. And also making sure that the American, the state looks strong compared to the rest of the world. So interesting to see what will happen with foreign policy. But then a big one, and actually this is good on the breakdown, is to see the national debt servicing. So he actually wants to spend, although it's counted as fiscal spending, it's going into servicing debt. So I think he's got a big drive that he wants to bring down that debt. Obviously, globally, debt has been in governments has been rising at quite a rapid pace, particularly post-COVID. I think the GFC started the trend, but post-COVID's really sort of upped it into another gear. And you've seen that globally, and I think Trump has a big focus on a bit of consolidation and kind of servicing that debt. So although you're seeing high fiscal spending, a lot of it will go into debt servicing. On the climate, some deregulation, and this is pretty much across the board, deregulation, reducing compliance costs. He wants to encourage businesses to start investing in America again. Over the years, you have seen this kind of bureaucratic creep. It's something that you're seeing in Europe as well. So I think he wants to just clean away a lot of that over regulation across the board, but particularly in the climate space. If you look at our view on inflation, so what does this do to inflation? A lot of people are saying, his policies are more inflationary. We don't actually think so, and we'll get into this in a little bit more detail later in the presentation, but we think his policies will actually be neutral on inflation. If you just look in isolation at the trade tariffs and you say, okay, well, if he's going to bring in trade tariffs on all imports, that should be inflationary because it drives up production costs. But what they're not taking into account is, well, if you're decreasing corporate taxes and you're decreasing what you're allowing there, you're allowing the free market to do is you're actually allowing competition to come back into it, and companies will start to undercut and to start using that additional cash flow that they have from the lower taxes to start looking at how do they kind of make their products and their services a little bit more cost effective because they've got that extra. So because you've got this kind of free market dynamics at play, it's not just easy to say, well, increased import costs is going to be inflationary, because the decrease in taxes could actually have the potential to be deflationary. And we'll talk about the demographics of why we don't think that his policies are going to be inflationary a little bit later as well. So it's a little bit more. So you look at the first round effect, you might say, well, the tariffs are going to be inflationary. But if you look at second, third, fourth round effects, you say, well, it actually could have a deflationary impact as well. So actually, both candidates, we pegged their kind of impact on inflation in terms of their policy is actually going to be neutral. You can offset a lot of both sets of policies. You can offset with market reaction to how that policy is played. Never underestimate the power of the free markets and the individuals acting in the free market to kind of negate some of those effects in terms of inflation in this case. If you look at asset classes, what we think is going to happen to asset classes, we think look, Chinese equities probably initially be a bit weaker. We've got a whole kind of thesis on China we'll talk about a little bit later, but we're not very confident on China for many reasons. We think probably the tariffs, particularly punitive on China, we think that's probably going to cause, it's not going to be good for Chinese equities. If you look at emerging markets in general, this includes South Africa, potentially a little bit weaker because it will probably have a restriction on global trade as these more as Americans businesses start investing more within their own economy. You'll probably see a stronger US dollar, and you definitely saw the dollar rally yesterday on the news of the outcome. And then potentially higher inflation for emerging markets, but that'll be because if the dollar stays strong, a lot of emerging markets import some of the inflation. So as we import goods, you're importing a little bit of inflation. So something to watch out for in South Africa as well. We don't think it's going to be a big impact, but potentially it could have an inflationary impulse if you see a sustained, continued strong dollar. So if you look at US dollar stronger, US equities we think will benefit from this. If you delve into the US market, I mean, if you looked at mid caps yesterday, mid caps are up about 6% on the day. Mid caps being, I mean, if you look at the large caps, they're much more globally focused businesses, but your mid caps are much more focused, starting to become more focused to the American economy. Obviously, investors like the news and like what the outcome around Trump's policies for the American economy itself. US Treasuries, so we expect yields initially to widen on, as I said, on the first round kind of reaction to potentially there being potentially higher inflation, but also if Trump is bringing down tax, so he proposes to bring down tax quite a lot, but he's still proposing to spend quite a bit. That should widen the budget deficit, and that should cause long-run treasuries, US Treasuries, to widen because you're in a less fiscally strong position. But if you look at where a lot of that fiscal spending is going to go to, it's going to go to paying down debt. So over time, when you look at the later effects, if you've got a country or the state with less debt over time, it's actually got a stronger fiscal position. We think that eventually that's actually going to be good for bonds. So we think the market's not seeing that. We're thinking actually that US Treasuries are still a good place to be for various reasons. And we think long run, that's actually going to be good for their bonds because you're actually going to get fiscal strengthening over time. In the beginning, it could have the potential to look worse, but over time, fiscal strengthening, and then also the fact that we don't think any policies are going to be inflationary, you're still going to have plenty of opportunity for rates to continue to coming down. So our view on rates is still very much we're in the top of a cycle and coming down. So we actually think that's something the market's kind of expecting a yield widening, which is what you saw on the reaction of the election. We actually think you'll probably see tightening over time. Sector wins. We think energy, traditional nuclear energy, gonna do well under Trump's policies. We'll talk a little bit about the nuclear a little bit later, and then US tech as well. US in general, but US tech specifically, we think will do well. So if we go into just where the US markets at the moment, how the equity's doing there. If you look, so economically speaking, still a very strong place to be. This comes out, Refinitiv publishes this every month. If you look at this. What this shows you is the percentage of companies in the S&P 500 that are beating, matching, or below their earnings expectations. You still got 77% of S&P 500 companies coming out beating expectations, and 5% matching. So you've only got about less than 20% that come in below consensus expectations. And if you look at what that quantitates, what that turns into on a quantitative level. The average S&P 500 companies coming out and beating expected earnings by 7.8%. So that's very healthy, and that breaks it down per sector, but that's still very healthy. So very healthy in terms of earnings coming through and beating expectations, which is generally good for a stock market. If you look at valuations and you take the mega cap 8, still, when you look at it in isolation, still looking expensive. So this is a forward PE over the next 12 months. So it's on a forward PE of 30. You say, okay, well, that's expensive, But when you look at where earnings growth is expected to be, long-term earnings growth, so that's earnings growth over the next 5 years, it's still way north of 25%. And then if you add into that to the fact that that's expected earnings, but as we know, earnings are actually coming out and beating expectations. We still actually like, I've ring-fenced the mega cap 8, but we still actually like vastly being tech businesses. But we still like the tech space, and it's because of, so it looks expensive optically, but when you look at the earnings that are coming out, those earnings unwind, that compounded effect of having 25% earnings growth over 5 years brings that down quite significantly. If you look at general stocks, S&P 500, looking a little bit more expensive than it has historically. So if you look at techs, although it looks expensive, not really more expensive than what it's been over the last sort of 6-8 years. It's kind of in line on average. If you look at, tech's been a lot more expensive and still done well, even though it's been at high PEs in the past. If you look at S&P 500, kind of tilting more towards the higher levels of its historical valuations. So we're a little bit more neutral on general equity. So we like our themes, but general equity, not bearish on, but a little bit more neutral. But what we really like, and if you guys will know that, we took quite a nice chunk of mid caps a while back, and US mid caps are looking a lot cheaper. But if you look, also expected growth a little bit cheaper. So you've always got to look at valuations in line with where expected growth is. But definitely, if you look historically, US mid caps relative to their historical valuations, looking pretty average, even maybe below average in terms of where they are usually. So we're thinking that's a much more of a value play. Here, you're not buying value, but you're still buying very good growth opportunities, whereas the mid caps give you a little bit more value. It's a little bit of a hedge against what some people might deem to be expensive. So we'll talk about the mid caps. So we own the mid caps. We've owned them for a while. They did very well for us yesterday. And that's, as I say, a hedge against just the rest of the market looking a little bit expensive. Interest rates and bonds. So if you look at the US economy, there's been a little bit of concern around the blue line, which is the non-farm job openings. So that's how many new job openings are coming into the market. Companies advertising for jobs. Okay. Generally, historically, when you look at that number coming down, you're seeing a big increase in unemployment, because when that number usually comes down, you're in a recession. So, here's the GFC. You can see there's COVID. So obviously, when you're in a recession like that, job openings comes down. There's no one's looking to employ, and obviously you get a subsequent increase in unemployment. But if you look here differently, the job openings are coming down, but they're coming down from a very elevated level. So they're actually just coming down and back normalizing with their long-term levels where they've been over the last 25 years. So although they're coming down, it's not concerning to us. Because it's just a normalization. You had a big increase in job openings post-COVID. Once they kind of switched off the economy, you had a big increase in jobs coming out of that as they turned the economy back on again, and that's just normalizing. And you haven't seen a subsequent tick up in unemployment. Unemployment, those are really big unemployment tick ups when you can see, and it's kind of been flat. You get your seasonality to it, so you see a little bit of up and down, but you can see the last number is actually unemployment coming down again. So something to watch for us, but still indicating a very strong US economy. And if you look at that, kind of translating into long run expected GDP of around 2%, which is where the US is quite comfortable. It's kind of moves around that 2% band. So we think, looking at this and what does this do for inflation, it's actually a deflationary impulse. Another reason I was saying what are Trump's policies going to do? I don't think they're going to be inflationary if you look at the policy aspect of this, but also if you look at the demographics, this is actually quite a deflationary impulse, because you're getting these job openings coming down, which means that the demand for wages is coming down as well, which means wage growth pressure will not be as high. If you remember years prior, one of the big worries around inflation would be that wage growth inflation that's coming through. And it was really coming up here when you had all these job openings and you had massive demand for wages, which means wage prices go up, which can be a feeder into inflation. That's unwound now. So that's quite a big deflationary impulse. And obviously looking at sort of long run economic growth, not very inflationary either. Adding into that money growth. So this is just US M2 money supply. This is kind of broad kind of measure of cash, basically. Cash in the system. It can be money market accounts, cash, things like that. Doesn't include securities. It doesn't include bonds. So pure cash. You can see that money supply growth has actually halted over the last while. And this, again, is a very deflationary, would have a very deflationary effect on the US economy. So you're coupling like the demographic, let's call it the money supply, and the demographics around the labor force, deflationary. So that should also offset some of the more inflationary aspects of Trump's policies as well. So if you look at inflation, where it's been, you can see inflation continuing to come down in the US. So headline inflation at 2.4%. Core inflation, which is less food and energy, sitting at about 3.3% at the moment. And then if you carve out shelter, and we'll talk about shelter just now, it's something that I've talked about in a few of our updates. Shelter, you're actually sitting an inflation of 1.1%. So shelter still being a big aspect or a big contributor to US inflation. If you look at the breakdown, this is the breakdown of US inflation to get you to that 2.4%. Shelter still contributing quite a big, having quite a big impact on that. And really, that's owner's equivalent rent. And that's actually not a real number, I think some of you will remember before. What that is they phone people up and they say, if you were to rent out your property, or if you are renting out your property, what will you charge next year? So how much will you increase your rentals by next year if you could? And people put down an answer and they aggregate that answer and that they incorporate into the inflation number. But it's not actually a real inflation. It's not a real inflationary cost. And that's a very lagging effect. It has a big lagging impact because, if you phone someone up and they've gone through high inflation in the past, they're going to say, well, they're going to increase their rentals by quite a bit. If they've gone through lower inflation in the past, they're going to give you a lower number. So it's a reaction to their own experience as individuals in the prior around inflation in the periods prior to when they're getting the phone call. So it has a lagging effect, and you can definitely see that playing out. This is average shelter inflation, which includes that owner's equivalent rent, and you can see it peaked and it's starting to come down. So as inflation comes down, that expectation of what you're going to increase your rentals by also comes down. And as we see this becoming more and more deflationary, that should have quite a big impact on inflation, because if you carve out shelter, you're looking at much lower inflation than where we are right now. Although we're close to the goal, we're coming low. So we're watching this quite closely, and we think you'll still see continued inflation reduction coming through the US, even in light of Trump's potentially inflationary policies. So bringing into the Fed. So if you look at US treasuries, so if you look at those orange lines, those are where futures are pricing. So that's where the market is pricing interest rates to go over the next end of 2024, end of 2025, end of 2026. But you can see where the Fed is. Those dots are the Federal Open Market Committee's expectations of where they think the short rate's going to go. So where they think they're going to put the Federal Reserve rate. And you can see that the consensus is a lot more dovish, a lot lower rates than what the market's pricing in, okay? So what's this saying is that if the FOMC continues to be as dovish, the market is not predicting as quick of a rate reduction as what's actually the Federal Open Market Committee is, and they're the guys that make the decision on rates. So it's quite interesting. So it could potentially be, so if you put onto this the fact that we don't think inflation is going to be a problem going forward in the US, we still think there's a lot of room for those rates to come down. The Federal Open Market Committee is saying that the rates should still come down, and they're quite aggressive on how they want that trajectory to look. And you're saying, well, the market's still pricing in higher rates. It's pricing them to come down, but at a less rate than what the FOMC is. We still think a very good place for US treasuries, specifically long-end, high-duration treasuries. And we like them quite a bit. So we still think, no inflation. We still think there's a very good opportunity in that space, in those treasuries. If you look into South Africa, inflation very much under control here. So if you look at core inflation, you're sitting at 3.8%, sorry, well below our mid-band of 4.5%. And then if you look at the core as well, so pulling out the food and energy at 4.1%. So really good numbers from us. So as I said before, Trump's potential protectionist policies could, if it causes proper like sustained US dollar strength, it could be inflationary for us to an extent if we import inflation slightly, but we still think the general sort of trend down will still be. We still think inflation very much under control in South Africa. and we still think rates will come down fairly rapidly from here, or fairly consistently from here. If you look at one of the things up till now that's been helping with inflation is the strong rand. So this is just the rand against the major currencies. You can obviously see, since this was the GNU here, the GNU was around here, the announcement, you can see pretty much strong across the currencies, very strong against the dollar, but you have seen some dollar strength, and probably could see a little bit more continued dollar strength, but still overall very strong against these currencies, which helps with our inflation quite a lot, because we import some of our inflation. And you can see, if you just look at the inflation breakdown of South Africa, that 3.8%, no real outliers in terms of where the inflation comes from. So very much under control. And if you look at this on the backdrop, the MPC agrees with us, and they're still predicting, about a percentage of rate cuts over the next year. So if you look at this, that midpoint, the FOMC in the last monetary policy meeting is expecting about, we're just over 8 now, to go down to about just over 7 a year out from now. So expecting kind of 100 basis point cuts from here. The FOMC, the American, they're meeting actually later today. It's probably we'll probably get consensus for a 25 book cut today, and then we'll probably follow on that in our next meeting with 25 basis points as well. So a little bit of easing pressure on the consumer as well. Nice to see, finally. So how does this tie up into our own bonds? We're still very bullish on our bonds. We've had a lot of questions around bonds, because bonds have obviously rallied quite strongly in the last few weeks, the last few months. And we've liked bonds for a long time. We continue to like them, even though they've rallied. And this kind of paints the picture for us. What this looks at is, if you look at this blue line, that was the South African bond yield 3 years ago. Okay, if you look at this orange line, that's the South African bond yield now. So if you look at your bond curve, let's say, the Orbi curve. So if you look and you say, okay, well, bonds have rallied quite significantly, but they rallied off a very low base. They're actually kind of yielding, on the long end, they're actually yielding more than they were 3 years ago. Now, if you look, the short end is still a lot higher. That's because, the MPC interest rates are a lot higher than they were 3 years ago. But that should come down. So what you should be seeing is this tail, or this left, the short end will start to come down in line, but the long end, really where we're looking to invest, the market's saying, we kind of where we were 3 years ago. So if you look at it 3 years ago and you said, okay, well, at that point, if I was going to invest in bonds, and we were liking bonds back then, if I was going to invest in bonds, what would my expected yield be? Well, the starting yield of the Orbi at that time, if you just went and passively bought the Orbi, your overall portfolio would have had a starting yield of 9.75%. If you consider what's happened within those 3 years, it hasn't actually been a good environment for South African bonds. If you look, we were added to the grey list. So that provided a slightly increased risk premium. We also increased short rate bonds over that time period by 4.5%. Interest rates went up. The MPC increased rates by 4.5% over that time period. But if you look at it, and actually what you saw was that curve starting to raise and recently come down over strong GNU sentiment. But if you look, still through that whole period, all that volatility and everything, bonds still returned over this period 10.5% for investors through that quite negative period. If you move that forward today, so what do we see today? Well, we see if you buy the Orbi just today, so if you buy that red line, you're going to get a yield of 10.2%, slightly higher than what you would have gotten 3 years ago. We're probably going to be removed from the grey list. So we're coming up for an audit in February. It looks like the government's making good headway in terms of covering that list. So there's a good chance that sort of by June, July next year, we'll be removed from the grey list. Okay, so that's going to be a positive kick for us. We've got the backdrop of positive government sentiment still in terms of the GNU. And we've also got the repo rate decreasing. So we've got rates. We're in a rate cutting cycle now, not a rate rising cycle. So you're going to see the rates starting to decrease, which could also be a tailwind on those longer run bonds. So, what is the forward return from here? We would say, statistically speaking, still a lot better than probably what you would have gotten here. So if you look midpoint for us right now, if we think midpoint for us right now, where we think you're going to be is sitting at about, if things play out like that, in terms of what we think. So if you get 100 basis point cut and there's no positive surprise, there's no positive sentiment around our bonds, sentiment stays neutral, and bonds just come down with what the MPC is expecting them to, or rates just come down by 100 bips over the next year. We still expect north of 10% on SA bonds. But if you look, we still think there's some positive sentiment and tailwind. If we get removed from the grey list, that's potentially a kick for us, a nice tailwind. And then also, just potential, if we get some wins, policy wins out of the GNU as well. You could still see some capital upside to those yields as well. So we're still thinking our base case for bonds, local bonds over the next year is still between 10 and 13%. We'd put it in that range. But also, if you get negative sentiment coming out or rates don't come down as quickly as we think, we still think it's an unlikely event. There's no inflationary. We think inflation under control globally pretty much. So we don't think you're going to see an inflationary sort of surprise on the upside. But if you did, or you saw negative sentiment out of South Africa, because your yield's so high, because you're still getting a very high yield, north of 10%, you're still going to have a lot of protection. So we're kind of getting this asymmetric payoff over the next year between what we think could be, but even if it's bad, you're still going to get fairly good, you're going to get 7.3% over the next year out of bonds. So still liking SA bonds a lot. In fact, we like SA and US bonds, as I've mentioned. So what does this do? Rand dollar, we had a lot of questions on that. Tying into that, real yields, although our bond market has recovered quite a lot, it was recovered out of a very oversold position. Real yields in South Africa compared to our peers, or some of our peers and the developed markets, are still very, very high. So, kind of in line with Mexico and Indonesia. Brazil's kind of a little bit higher, but Brazil's got higher inflation than we do. So if you're looking, still very high real yield. So it's still very attractive. So, we're still a very attractive destination for foreign investors in terms of our bonds. And that could still be very supportive of the currency over the short term. So as I said, currency has strengthened since the elections. So you're going to have this it's going to be interesting to see what happens with the currency, because you've got the protection policies from Trump, but you've also got positive sentiment around our markets and our bonds and our GNU. So we still think going forward, we're not going to call the currency either way, but we don't think it's going to be very far off where it is right now. We don't think it's going to go back to where it was pre-elections. So we don't necessarily seeing it strengthen further from here, but we don't see it weakening either. So we kind of think where we are right now on a balance of forces is probably where you want where it is. But a good thing as well, we've had a lot of questions around the Rand dollar. We've had a lot of questions around bonds. The importance is just diversifying your portfolio. So what I put in here is I've put our enhanced ops fund, a high equity fund, and I've said, this fund has at the moment about 40% offshore, and you've actually seen a very strong Rand over the last while. So what we did is we said, since the GNU came into, and you've seen this Rand strengthening, even though the fund, so if you look at this Rand dollar, it's strengthened quite significantly, but our fund has still done very well, even though a lot of it is exposed offshore. And it's because we're getting that diversification right. We're hedging the portfolio correctly. So what we're trying to do is we're trying to get the best of various different, we can't predict what the outcome is, but what we're saying is if you get a specific outcome, what's the best way to construct the portfolio in light of that? So what we've done, was very intentional of us. So although we have 40% offshore in this fund, and the Rand's been strong, where it's been invested offshore has been very good for us. So, if you consider, well, if the Rand's going to be strong, it's probably a risk-on environment for the globe. So you want to be in your high beta stocks overseas. So you want to be in the nuclears, you want to be in the techs. And that's paid off for us very well. So although we've had a strengthening Rand, you've also had very strong offshore markets that we've been invested in that offsets that. And then also locally is, how do you offset that with your local investments? Well, for example, we've owned SA long-term bonds for a long time. So when you see a strong Rand like this, you also see a massive rally in long-run bonds, which has helped us a lot. So we've had a very nice, the fund up north of 8% since the Rand started to strengthen, and you haven't seen it, and although we've had a lot of the portfolio offshore. So it just kind of highlights the importance of diversifying. Don't think of one, don't spend too much time looking at one specific parameter. For example, in this case would be the exchange rate. You've got to think of how it all sits together, and that's where the portfolio construction comes in very powerfully, and that's what we focused on at New Road. So, getting those asset allocation calls right and understanding how everything fits together in the bigger picture. So yeah, long story short, we think that the Rand's probably at fair value where we are right now. I will hand over to Mike. So Mike's got some interesting talk around China. Obviously, we saw a China spike recently, but we're not that bullish on China. We're still kind of very skeptical. But I'll give it. I'll let you go for it, Mike. Take us away.
Cool. Cool, thanks. So China's seen a lot of economic strain over the past few years, driven by deep structural challenges to their growth. And we can see this playing out particularly in the demographics of China. If we look at first the age dependency ratio, this measure essentially tells you how many people of non-working age relative to the number of people working age. So in 2000, it was roughly one non-working age person for every 10 working age, but this is now doubled to 1 in 5. So we've seen essentially a shrinking of the potential labor force, and coupled with that, we've seen a decrease in the population growth to the point that it's actually now negative, which is for the first time since 1961. So we're seeing both a shrinking in the population and within that, a shrinking in the potential workforce. And all of this translates through to low economic activity overall, both in terms of production and consumption. And we can see that in the inflation print, which has been very, very low and fighting off being deflationary. So history doesn't repeat itself, but it does rhyme. And what we're seeing here is very, very similar to the Japanese demographic collapse that we saw and subsequent lost years. To try and fight this off, the CCP have been using a number of different stimulus measures. The most recent one in October, which caused the spike that we saw, was one of the largest since 2008. Initially, we saw the spike because of the announcement of that it would be a very large stimulus package. But as the details came out, it fell short of what the market had hoped for. Many believing that more was needed to spur economic activity. But inside of that, a question of does the CCP, are they doing this because they don't have enough firepower so to tackle this crisis? In addition to this, we've seen a general move away from liberalization in China with large crackdowns across the private sectors. And Jack Ma went missing for a couple of months and has now turned up as a university lecturer with no more real involvement. So all of this puts a lot of pressure on both the Chinese economy as a whole, as well as Chinese equities. So overall, our stance on China is very much neutral. We've seen that the equities are cheap and generally the market's expecting good growth, and they do remain as the world's top manufacturer. But all of this has some major risk behind it. I mentioned the political risk and demographic risk. This impacts both the growth estimates, which we believe to be a little bit or not sustainable, as well as the fact that if the CCP doesn't have enough firepower to spur economic growth, then they're not even going to be able to create this growth synthetically. And finally, also affecting their growth is the Trump tariffs, which just adds further headwinds to the Chinese market. Overall outlook on China's, we are remaining neutral on it in our EM exposure, but not taking any weights towards it at this point.
So just to kind of summarize on that as well. So if you look at our EM, we do think the Trump coming out, kind of a little bit more protectionist. It's not going to be as great for EM in general. So we're not, that exposed. We much prefer in our offshore equity to be exposed to the US. We favor that for a while, and we continue to favor that. We think you want to have a much higher chunk of your offshore exposure directly in the US. And that obviously translates into lower exposure in the EM space. So within the EM space, we're still kind of neutral on China, politically, demographically, economically, not looking good. The only thing they do have going for them is the fact that the equities are still cheap. If you look at the PE, it's on a PE, forward PE of about 10. So it's looking cheap relative to where it's looked in the past, but you've got obviously these big overhangs, long-term expected growth sitting at 18. So if you look at that in isolation, you say, geez, you want to buy these Chinese stocks. It's got good growth and it's cheap, but we don't think that that's sustainable, and we don't think that the market's believing that number. And you can see it here, the fact that, the market got very excited on the stimulus, but you can see as the details of the stimulus came out, it was quite an anemic stimulus. It was lowering of interest rates, it was lowering of mortgage rates. lowering of bank reserve requirements, which is a bit of a fudge. I mean, there you're kind of adding when you say you're going to lower bank reserve requirements, that means you're increasing risk to banks, potentially. And then allocating, 28 billion for local government infrastructure projects, $28 billion. It's not, I mean, if this is the kind of firepower that the Chinese government has to get themselves out of these doldrums, that's not very encouraging. And that's what you saw the markets kind of seeing that. If they came out with, $100 billion worth of spend straight into people's bank accounts, like a COVID type stimulus, you'd probably see a little bit more here, but it really was nothing like that. So you're seeing this kind of drop and really a market disappointed. Now you add onto this the backdrop of Trump winning the election, and you put in tariffs coming through now, that's going to hurt as well. So we're not a huge fan on China. We remain neutral within emerging markets, but we wouldn't be investing a lot of capital in China right now. So yeah, if that makes sense. But optically looking cheap, but we think cheap for a reason. Garrett's going to take us through some nuclear energy. So obviously, we like our thematic investments. We've held nuclear for a while. We've also held semiconductors and continue to do so. We like US tech, but really quite interesting on the nuclear energy, what we're seeing there in the developments that have come out in the last while, and still a sector that we're very much excited about. So Garrett, yeah, take it away.
Yeah, thanks, Paul. So yeah, I mean, as most of you probably already know, and as Paul has alluded to earlier, like we kind of tend to focus on asset allocation when we construct our portfolios. That's where we try to get most of our performance from. But we also do like to add some growth themes here and there for some extra alpha and some diversification purposes. And if you've seen any of our presentations before, then we've spoken a lot about semiconductors especially. And, we still like that theme. And, we think that the AI revolution is still very much on the way. But there's another beneficiary of that theme that we'd like to point out today that maybe not a lot of people have thought about before. And as you could have maybe seen from the agenda, that would be the nuclear energy industry. So when you look at these companies that are kind of driving the AI revolution, people like Google, Microsoft, Amazon, Meta, those people, they've had a tremendous increase in their data center usage. But what the problem is here is that back in, like 2020, 2019, all four of these companies that I've shown you have actually created emission targets that they want to reach by 2030. So they actually want to be net zero emissions by 2030. Which is obviously quite a big feat if you think how large these companies are. And you can actually see that some of them are struggling at the moment. Like Google at the moment, their emissions are actually up 48% since their base year of 2019. And Microsoft, they're up quite substantially as well, 29% from 2020. So, this is despite the headways that they've made in kind of making their processes more efficient, cleaner, etc. And that just shows, that they've got quite a long way to go, and they need to invest in stable green energy sources. And at the same time, Amazon and Meta, while they've already achieved their targets of being net zero on a carbon emission basis, they'd like to keep it there. They don't want to see an uptick in emissions now again all of a sudden. And this is all in the backdrop of their increased data center usage, which is very, very power hungry. As you can see in this slide, data center power demand has gone up tremendously, and it's only expected to go up even more. This research from Goldman Sachs actually predicts that by the year 2030, the data center power demand from AI alone will make up about 25% of the energy demand from data centers. And this trend is kind of going to be there globally, but especially in the US. And if we just go into the next slide, this just happens to coincide with kind of a reinvigorated interest in nuclear power, particularly in the US. Even before this whole AI thing started kicking off, you saw some regulatory policy support from the US for the nuclear industry. For example, late last year, the Nuclear Fuel Security Act was put into place, which is basically just focused on the expansion of US nuclear fuel supply. Increasing the production and availability of low enriched uranium, and then also high assay low enriched uranium, which is used for the more advanced next gen reactors. Very soon after that, the Atomic Energy Advancement Act was passed, which just makes the regulatory and administrative requirements cheaper and more efficient if you in the nuclear industry, so you don't that things don't just get stuck behind big red tape. And then at the same time, the G7 itself, at their summit last year, they kind of reaffirmed their support for nuclear energy, and they actually want to triple global nuclear power by 2050. So there's a lot of support from that side. But then also now tying into what I was saying earlier with the data center requirements in terms of energy, you've seen a huge demand from the commercial side as well. So like last year, Microsoft actually signed 2 deals with nuclear power providers. There were 2 new nuclear reactors that actually connected to the grid in the US. Amazon bought a data center campus next to a nuclear power station. And then now more recently, I almost don't have space in this graph to fit all the things that happened, but Microsoft signed another deal to get power from a nuclear power station. Then more interestingly even is that both Google and Amazon have made multiple partnerships with companies developing small modular nuclear reactors, which are particularly interesting in the data center space, because what makes these special is this is kind of the next generation of nuclear power plants. Up until now, these plants have been quite big and take long to build. They're quite expensive, but the small nuclear reactors are unique in the sense that they can basically be built in a factory, and much cheaper to build, much quicker to build, and they safer and more efficient than previous iterations. And these kind of serve the ideal purpose for a data center. I mean, when you build a large data center, you can basically build that anywhere now, and you can just bolt on a small modular nuclear reactor to power that. There was actually another piece of news that came out recently that I don't have in this graph now, but Oracle has also in September announced a new data center that they building that will actually get about a gigawatts worth of power from 3 small modular nuclear reactors. So yeah, it's very exciting. And if we just go into the next slide, you can see that the interest in this theme is really kind of shown in its performance. What we've got here is just the performance of our nuclear theme since we've invested in it, benchmarked against the MSCI World Index. And you can see it is a bit more volatile, which is why we have it as one of our, it's not our main holding, it's just there for extra alpha. But, it's really outperformed really nicely, given us about almost 25% excess return above MSCI World. And yeah, it's done really well for us since we invested. So yeah, we're very happy with how this theme has played out, and we think it still has some legs. Yeah, back to you, Paul.
Yeah, thanks, Garrett. Yeah, so probably look to take advantage of this dip as well, especially in light of Trump victory. We think he's quite supportive of traditional forms of energy, but also nuclear. So I think the world has slowly started to realize that your sort of, let's call it your renewables, they're not very reliable, very inefficient in terms of energy generation. You need a lot of space. You need a lot of, to build a solar farm or like even a wind farm, you need a lot of land to get the energy requirements out. Whereas nuclear, a lot more efficient, a lot cheaper actually, and a lot more reliable. You can run it, you can run baseload requirements of it. You don't need the sun to shine or the wind to blow to generate the energy that you need. So yeah, obviously the data centers or the big tech companies have really bought onto this, but definitely a lot of support, I think, from the Trump administration as well. So a theme that we like a lot, and we think that has a lot of legs. So thanks for that, Garrett. We got a query from a few of you as well. We put out a thought piece, just to finish it off. We put out a thought piece a few weeks ago around, I think investors can be interesting, because obviously if if you're in a market dip, investors will often say, well, let's let the market improve and then we'll invest, So they don't invest near the bottom. They start kind of buying after you've had a recovery. It's kind of this risk avoidance bias that we've had. But you also get the opposite bias where a lot of people say, well, if the markets are at an all-time high, should I be investing now? And am I going to get a decent return now that markets are hitting all-time highs? Is it a good time to invest? And we've, obviously markets have been strong over the last while. Pretty locally and globally. I mean, equity markets have been flying. Bond markets have been doing particularly well as well, specifically locally. Is it, everything's going well? Should you be investing now? Should you be looking at buying new equities during all-time highs? And we've actually done a lot of work around this. And what we did here is we said we just looked at the S&P 500 over the long run, and we said, what is the long run return you'd get if you just bought the S&P 500 30 years ago and you owned it now? What would your return be? This is a total return, so it includes the reinvestment of dividends. And you're looking at about just north of an 11% annualized return through that. So obviously you got your ups and downs and your volatility, but you would have done about, just buy and hold, you would have done about just north of 11% in US dollars. Pretty good investment. So we said, okay, well, what if you just bought, if you just bought and held every time the market made a new high? So what you do is every time the market makes a new high, you buy, and then you invest for 1 year. So this first column just shows the 1 year outcome. So if you invest now, you hold it for 1 year, and you did that for every rolling period where you had a high point in the market, what would your subsequent return have been? And actually, on average, it turns out that investing at a market high point over a year, statistically, you're going to do better on average than you would over holding it through the long run, which is quite interesting and quite counterintuitive. You'd say, well, if you're investing at a high point, you're at a high point, like, you're already at strong markets. Why would you do more? And it's because there's quite a strong momentum effect that happens. Markets generally tend to run for a while. Even if you say, okay, well, it's expensive and it's at a high point, markets will generally tend to run for a while. So on average, you're actually going to do better by investing at a high point than you would by investing at any point through the cycle, if that makes sense. So quite interesting. If you extended that to 3 years, you say, well, okay, maybe that's just going to run out and eventually you're going to get this sort of big retracement. So yeah, you're going to be okay for a year. What about after 3 years? Well, after 3 years, you're getting the same kind of outcome. Your 3-year subsequent return is actually going to be slightly better than your 3-year average return where you invested it anywhere in the market. So that's quite interesting. And then if you looked at 5 years, kind of similar. What's all that you're seeing happening here is your 5-year return starts to normalize to the long run return of the market. So because the market's volatile and it's moving in cycles and it's doing its thing, it doesn't really matter where you invest or when you invest. If you hold it for long enough, your returns are kind of going to converge anyway to the long run kind of return of the asset class itself, which is very interesting. So it highlights the importance of investing and staying invested and not trying to time the market. So whether you're at the bottom of the market, in the middle of the market, or at the top of the market, if you're investing for the right reasons and you're investing, you want to be invested in equities over a long period of time. You're not there to time it in and out. If you're investing for a long period of time, your subsequent return that you get is going to be more or less in line with the long run returns you're going to get wherever you invested that portfolio. So it's very interesting. So it just highlights the importance of staying invested and not worrying about when you get into the market. So it's not timing the market, it's timing the market. It's a very old adage, but this is just another illustration that kind of points to this fact. And really, so, markets are at all-time highs, but we're still quite bullish. We still think that you're going to do well from here. But we've hedged it out. That's the importance of portfolio construction, is that you're hedging it out with different types of asset classes in order to get an overall protected and well-constructed portfolio. And that's the important thing. And then it's about sticking to your investment time horizon, sticking to your goal and letting it do what it needs to do. And ultimately, you're going to do okay that way. So just to kind of summarize and where we are at the moment. So if you look at our outlook, we're very bullish on our themes. So if you look at our thematic equity holdings that we own, still like them very much. So, mid-caps, US mid-caps, we think are still going to continue to do well under Trump. We like US tech. We like the semiconductors. We've spoken about them a lot in the past. And then obviously our nuclear energy as well. We still like that and probably going to up weight on that a little bit as well into this recent dip they've had. Where we neutral, where we still bullish on offshore bonds. So offshore bonds, as I say, providing a nice opportunity. They've had a bit of a sell-off of late. And we think it's provided a nice buying opportunity. We think that the interest rates will continue to come down, and futures are not pricing that full extent of that into them. So we think good there. We also think policies under Trump, if we do get some fiscal consolidation, that's actually going to be good for bond yields, and it's going to cause a deduction in the risk premium, which will also cause bonds yields to tighten. And then also just the whole backdrop, the backdrop, the tailwind around, we still think rates are going to come down. We don't think inflation's there. And then on top of that, you're getting a nice protection by buying bonds. We recently upweighted bonds across our holdings quite significantly, between about 7% and 5% across our portfolios, because it also provides very good protection. If we do see, and this is the importance of portfolio construction, if we do see some volatility in the markets, those bonds generally, they tend to have negative correlations and tend to protect portfolios when you need them to do that. So we think they're investable. We think you'll get a good yield out of them, and plus quite a decent capital kick out of them. But they're also providing you that negative correlation when you need it. So great from a risk return outcome. So we're quite bullish on offshore bonds, particularly US long-term bonds. Local bonds we're still bullish on. We've talked about them. You're still getting a very nice yield, and we still think we probably have some tailwinds on the South African market. So we still like local bonds. Again, top of the interest rate cycle, rates coming down. And then US property, which we haven't really spoken about today, but we like US property for the same reason we like kind of US bonds. We think offering a very nice yield. They haven't ran as far as the rest of the market, looking a lot more value and a place that we like. So we still like that. Neutral. So we're kind of neutral on general offshore equities. We're not negative. We still think general offshore equities will do well, but not better, kind of neutral, like long run expectations. So you could say we still like it, but neutral in terms of our allocations around it. We much prefer our thematic kind of tilts that we have. Local equities, same thing. So, there is a backdrop, obviously the GNU, there's positivity around that, but you still got your sort of, the problem with South Africa is, although we've got the GNU, we haven't had a lot of changes. It's going to be hard to see policy reversals. So you might not see a further policy or negative, policy that seemed to be negative to the private sector coming out, because obviously the ANC's lost a majority in Parliament. But it doesn't mean you're going to see a turnaround in policy either. So where we see, you could still have positive outcome for bonds, we don't think the economy is going to start growing at 4 or 5%. And that's not really going to be great for equities. So we think equities will do okay. They're still looking good. They're still looking cheap. They have run a lot lately, but they're still looking cheap. But combined with the fact that you've still got potential negatives associated with the growth, with the growth aspects of South Africa, the growth aspects around the economy, and you need growth to grow equities. It's going to be difficult to see where that comes from under the current backdrop. So it's not that we're negative local equities, we're just neutral on them. We think they'll kind of continue to do kind of average returns going forward, and the same with local property. Local property has had a very good run. It was very cheap, but it's kind of run and it's kind of outwound some of that discount. So we're not negative on it, we're just not particularly positive on it. So we're neutral on those kind of asset classes. So how does that fit into our positioning? As I've said, we like the US treasuries, and we think it would be a great hedge as well. So we think it's investable, you're getting a good yield, good returns, but also we think it's going to be a great hedge against any potential volatility in the portfolios. And then obviously our thematic ETFs that we continue to like. And as you know with us, we're not trying to time things and get in and out quickly. When we make out these thematic calls and investments, we really do see them as investments, and we like to hold them for long and extended periods of time. So we're really looking for those kind of secular trends, thematic trends, and paradigm shifts, and that's how we hold, and that's how we look at these. So, we've owned nuclear energy for a while now, over a year and a half, and we continue to hold it and like it a lot. We're not going to try and time our movements in and out of it. We think it's a great investable. There's a great investable case to be had for it. Same as our semiconductors, same as our generalized US tech, and also the US mid caps. We like a lot. So that kind of wraps it up from my side, guys. A lot to go through, but thank you very much for your time. And I don't know if there's any questions, Sarah.
Yeah, thanks, Paul and team. That was very valuable. It's great to see all your insights. We have 3 questions at the moment. So any other questions, you guys are welcome to pop in the chat.
I think
So the first one,
sorry to interrupt you, Sarah. I think anyone who needs to, we will apply for CPD points. So you'll get your points. So anyone who needs to log off and has time crunches, please please feel free to do that. But anyone who wants to stay around for the questions, you're welcome. Yeah.
cool, thanks, Paul. Yeah, the first question from Yuri. When you were speaking about the impact of the US elections on China and emerging markets, he would just like to find out about how that would potentially impact the BRICS countries in particular.
Yeah, so BRICS is an interesting. So it's hard to BRICS as BRICS, if that makes sense. They're actually very differing countries and differing nations. So some of your BRICS are kind of anti the US. If you take specifically China, Russia, that would be seen as sort of, you could throw Iran into that mix, you could throw North Korea into that mix. But then if you could look at like Brazil and India, I would say probably somewhere in the middle here. But if you take Brazil and India, not necessarily anti the US, just kind of more protectionist in terms of, and you could probably put us into that as well, as more protectionist in terms of our foreign policy. So essentially not saying we're anti-US, but we will deal with the US where it suits us, and we'll deal with other BRICS nations where it suits us. So India is kind of very big into that. So it's hard to it's hard to like block them all together into one thing and say BRICS. BRICS is actually not a there's been a bit of overhype around the BRICS. It's not like the UN. The UN, when you sign up to the UN, there's a whole charter. You need to undertake certain, as a nation, as a state, you need to undertake certain standards, and there's a whole charter. Joining the BRICS, you just like sign on. It's not just like a very easy club to be part of, if that makes sense. So, but a lot of differing kind of national interests within those BRIC nations. But as a basket, let me break it up. I think Trump could be probably going to be more protectionist against China, as I've mentioned already. So, and we've talked quite significantly about China. So, we kind of not that positive on China, and we don't think that the Trump administration is going to help their cause at all. So we think probably China negatively affected. Russia, it's interesting with the Russia-Ukraine war. It's going to be interesting to see what Trump does there. It's very unknown, but in terms of his foreign policy, he's been quite strong on saying he would like to try and negotiate a peace deal there. So we'll see what that looks like, and we'll see if he can do anything in that respect. As I say, he's got a very strong mandate this time around, a much stronger mandate than he had in 2016. So it's going to be very interesting to see what happens there. But potentially it could be positive for Russia if a deal comes through that seemed to sort of kind of save Putin's face a little bit. I don't think Putin wants to be in the war anymore. I think it's kind of been a war of attrition. If you look at the Biden administration, they've been funding a Ukraine defense campaign, but ultimately it's just dragging out. And ultimately, eventually what would happen is probably if that conflict continued for years and years from now, and as whatever under the Biden administration in terms of funding a Ukraine defense campaign, you're going to see this attrition. Eventually, you'd still probably see Russia winning. Because what would happen is you'd see the West kind of losing interest in terms of helping Ukraine out. Other political interests kind of overtake interests over a time period, and it would probably just be a drawn out kind of battle of attrition, and it would probably cost the Ukraine the nation, that ultimately probably end up losing it, and it would cost Russia a lot of money. So I think the best way forward is to probably negotiate some kind of peace deal. Obviously, the devil's in the details there, but we'll see what happens with that. But an interesting case, but it could end up being positive for both Ukraine and Russia on a net basis. India, Brazil, South Africa, I think more neutral there. I think those nations will mostly do what suits them in terms of foreign policy. So it remains to be seen. But I think if you basket emerging markets as a basket, not just the BRICS nations, but emerging markets in general, you're probably on a net going to see a little bit more protectionism from the US, as I've said. So probably a little bit, maybe some imported inflation in a lot of those countries, but it's not easy to just basket them all if you want to look at specific nations. So I hope that kind of answers the question. I think Iran, Trump's going to be a lot tougher on Iran, I think, than he was. I mean, he had sanctions imposed on Iran in his previous administration, which were kind of undone. under the Biden administration. I think he'll continue there. So it'll be interesting to see what happens in the Middle East. But, really, if you're looking at the sort of enemies of the US, ideological enemies of the US, China, Russia, Iran, North Korea, I think probably, look, North Korea is an isolated nation. They're not really economically open, so probably limited economic impact there anyway. Not that they're a thriving economy, but yeah, I hope that answers the question.
Yeah, thank you, Paul. The next question from Evan was, would you say that India is a good alternative to China in a portfolio? It seems like they have similar future to China in the early 2000s with high growth prospects and a political regime pushing the agenda.
Yeah, there's been a lot of thought around that. We do think it has the potential, and the short answer is yes. We think it could be a potential replacement to China. The devil's in the details again. We think that it's not going to be able to pull out the rabbit out of the hat as quick as China could. China still being a very centralized economy, communist nation, a lot of power sitting within the government. It's easy for them to turn on and off switches at will very quickly. So if they want to stimulate, if they want to create sort of a market-friendly dynamic, it's a lot easier for them to do it a lot quicker. They also emerged out of a much lower base than India would emerge out of now. So you must remember under, we're going back in history now, but if you go through the Cultural Revolution and it's kind of Mao's China, it really put China many steps below the rest of the world. They weren't just a poverty-stricken nation. They were absolutely obliterated. I mean, they came from a very low base, so it's easier to see. So the pickup came off a low base, but you also have the Chinese authorities that were able to turn on and off switches very quickly. India's not, it doesn't have the same, it's a lot more of an open market kind of economy. I do think there's government support, so I do think it'll be good, but probably you probably won't see it to the same extent as China. Our view on emerging markets in general, so we don't think of it like, would India replace China? We think like, there's a lot of places to invest in the globe, and we actually just think on a balance of forces, if you say US, India, and China, like US for us is the best option. So it's not about like, do we replace China with India? We just look and say, where can we invest? Where would we like to invest? And we look at it like that. So we own our emerging market exposure still very much in a basket. We're not going to try and pick which one's going to do better. Is it going to be India or China? But ultimately, we just prefer the US as an investment case than your big emerging market economies right now. That makes sense. But yes, you could have a big benefit in India. The other problem with India is they actually export a lot of their talent. So, they're the biggest like tech talent. I mean, if you take, these big tech giants, they hire a lot of Indians. So they actually export. They're probably considered, they're probably the best in terms of like technological education in the world. Your Indian universities are probably the best. They're training a lot of very competent coders, programmers, tech guys, and then a lot of those guys, bright guys, will go to the US because that's where all the opportunity is. So you've got this other dynamic there as well, is that because it's a much more open economy, you don't have like a forced, you don't have to stay here and like grow the Indian economy. You can go and grow the US economy, go and get into, Google with the US, or go and become a tech entrepreneur in the US. So you're seeing there's a lot of dynamics at play. They're a much more open economy than China is. So the extent to which they could just turn on knobs to grow the economy is more difficult.
Great, thank you, Paul. The next question we have is with Iran threatening to attack Israel and the US. Are there any dangers of the US market underperforming in the near future?
Yeah, of course. So look, unfortunately, global, kind of violent conflicts aren't always bad for equity markets. Actually, sometimes they can be quite good for them. Also, depending on what sector you're in, it does force investment into economies. It generally will, if it's a big enough conflict, what it'll do is it'll also cause a lot of public support for government stimulus and interventions and things like that. So it's not a foregone conclusion that you have weak equity markets because you have conflicts. The whole Iran thing is interesting. We actually think Iran is weaker than what they pose to be, or what they try and present to the world. It's quite an autocratic regime. If you try and get information, it's hard to get information. But if you look at the underlying populace in Iran, they don't support the regime at all. We don't think it's going to take a lot to overthrow or to potentially overthrow. I'm getting very political here, but I think it does kind of tie into the economics and obviously global equities. But we think that what Israel's doing in the Middle East, and particularly with Iran, we think probably will show the world that Iran is not as strong as a lot of the Western nations think it is, and not as capable as a lot of the Western nations think it is. We think kind of the emperor has less clothes on than what he's trying to show the world. So, and they don't have the support of their people. So it'll be interesting. I think the risk of Iran attacking the US, attacking Israel, I don't think they can do it, to be honest. I don't think it's possible without getting sorted out very quickly. So, I'd put that risk very low, but even if that risk were to happen, it's not necessarily bad for equities. I think probably for tech, it would be quite good. Tech tying into the military and defense. Could probably see a run there. But yeah, but I don't think that's not a risk that we have that we think about really. We don't think it's a big risk. We think that conflict will still stay kind of very much isolated to the Middle East.
Cool. Thanks, Paul. And then the last one, I suppose, sort of ties in terms of conflict as well. What are your thoughts on Trump being elected, playing into a potential World War III situation?
Well, Trump's been pretty clear on his policy about kind of anti-war, so you'd have to see where would that come from. So if you look at the sort of big enemies of the US, ideological enemies, you got Russia. It's already tied up in a war with the Ukraine, and Trump's plan is to go. Now, I don't know if it's going to be successful or not, but the goal is to try and negotiate a peace deal there. So that's kind of would be seen, and he's been very clear on that throughout his campaign. So that kind of removes any threat from Russia. I think, if anything, up till now, Russia's kind of been pushed into the hands of China, politically speaking, because, the Western world has just put sanctions on them. It's been very kind of punitive towards Russia. Not saying that's the wrong move. I mean, Russia attacked a sovereign state. But if you look at it from Russia's perspective, it's been very punitive. And it's actually pushed them closer to countries like Iran, countries like South Korea, countries like China. I mean, if you've seen South Korean troops fighting on the Ukrainian front, shows you that Russia's not that powerful, not as powerful as it wants to project. The difference is it's got a very strong nuclear capability. But I think if Trump comes in there, I think you probably see that actually causing less tensions around Russia. Around China, I think China's an interesting one. They can be quite unpredictable in terms of what they do. Still very much a centralized government and very autocratic. A lot of power under Xi Jinping. He has become a lot more autocratic over the last decade. Been a lot more cracking down politically, a lot more on China. They were a lot more liberal 10 years ago than they are now. I think any escalations there would be driven from the Chinese side, not the US side. And I think China probably under a Trump administration would be a little bit more, would think twice a little bit more about their own foreign policy objectives. Taiwan's been a big kind of been on the radar there. I think under a Trump campaign that probably discourages China from walking into Taiwan than it would have been under a Biden administration or Harris administration. So I think there again, China would drive that, but I think probably it detensions around China as well. And then the last one would be Iran, which I've spoken about already. So I think no. So I don't think the risk of a World War III, I think, is probably lower now than it was under a Democratic administration. And I think Trump's been pretty clear on his kind of view on that. So, Trump's going to be more protectionist. He's going to worry about the US economically a lot more. But I think in terms of foreign policy, he's very much on the side of he doesn't want to get involved in war. There are aspects of the conservative government or the Republican government, the neocon kind of carve out of the Republican government that is still very much pro-war, but that's not Trump. Trump doesn't really sit in that kind of camp. So my personal view is that no, I don't see the risk of any kind of escalating conflict from here. If anything, I think the reverse is true.
Great, thank you, Paul. Yeah, that brings us to the end of our questions. So thank you so much to Paul and the team for putting together a very insightful presentation and answering all the questions that have been presented. And thank you to everyone who's attended, who's taken the time out of their days to prioritize this. We really appreciate it. And yeah, we hope that you guys have a fantastic rest of the year and last one into December. If there's anything we can assist with, please get in contact with your investment consultants. We're happy to answer any other questions you have. So yeah, thanks all for attending and have a fantastic rest of your day.
Great. Thank you, guys. Thanks for your time. All the best.